Inflation is up, growth down, unemployment rising, oil price up, corporate profits uncertain, fiscal deficit mounting, rating outlook negative. Are the equities down? Of course not. Market is sharply up on decisive action from the government. Market expectation was finally met last Thursday when the government increased diesel prices and limited cooking gas consumption at concessional prices. Friday, they followed it up with a slew of relaxations in FDI arena, including the most divisive one in retail FDI. The market simply exploded, backed by a massive 2.9 billion rupees of FII buying. Nifty cut through its previous top of 5448 to end the week at 5577. Far away, Uncle Ben simultaneously delivered on his promise, around $80 billion per month of bond buying without any ceiling. The program is only limited by the indeterminate amount needed to bring unemployment down to bearable level. In the context of a US government paralyzed by obstructive politics, this opens up a new frontier for central banks beyond the traditional objectives of growth and inflation targeting. Globally, equities shot up, recording new highs in many markets. Mr. Draghi of ECB, under fire from Germany for his accommodative stance, must be deriving new inspiration from Fed's latest action. Predictably, last week's decisive action, prompted by the fear of a rating downgrade, has raised a political firestorm. All parties, including allies, are frothing at the mouth. Short of providing any alternate solutions or withdrawing support, threats and ultimatums are flying thick and fast. With its credibility severely eroded, the government can't afford to roll back and looks set to battle it out. At this point, it is difficult to say who's going to blink first. But unlike US and Europe, the compulsions for Dr. Subbarao were vastly different. Since reducing rates in January, he has steadfastly maintained an anti-inflationary monetary policy stance, goading the government to tackle the fiscal deficit first. The one measure of hiking diesel prices by 5 rupees per litre should fetch the government around 20,000 crores. Not a significant amount, though, in the context of latest estimates of fiscal deficit exceeding 600,000 crores, but a welcome first step. Meanwhile, inflation for August has jumped to 7.57% from 6.96% in July, and perhaps it is too soon to assume that the UPA government will be able to withstand the pressure from allies and a sizable part of Congress itself for a rollback. No wonder Mr. Subbarao, very sensibly, resisted the pressure and kept rates unchanged while releasing a large dose of liquidity in the system by reducing CRR by 0.25% to 4.5%. For equities, the question now is what next? RBI's next meeting is scheduled for 30th October, 6 weeks away. While the diesel price hike is a good start, by itself it's not going to change the ground reality. If at all, in the short run, it will push inflation up, and there is already a demand for 15% hike in freight rates. While the mood swing is welcome, Percentage Play believes follow-up measures are imperative to sustain the market momentum. So far, it was only the CAG, the Supreme Court, and the RBI who are running the country. The only change is that the government has finally decided to chip in. Now, that can cool the temperature a bit. Technical suggests the Nifty should face resistance at around 5,600 to 5,650 range. With mood lifters out of the way, the market is likely to face the heat of across-the-board price rises, which could bring in some reality bites. The gap-up opening on Friday also suggests that at some point Nifty will retrace its movement to fill the gap between Thursday's high of 5448 and Friday's low of 5526, thereby confirming the breakout above the previous intermediate high. So the week promises action. We will be looking to play the market on the long side, but keeping in mind that there can be near-term shallow corrections. Indeed, that will be the best time to get fully invested. Quant Pair Fund had an excellent week. The good run continued as we booked profit in 5 pairs. We currently have 2 pairs open. Our annualized return has risen to 20% and the outperformance is running at 24% against Nifty. The number of wins stands at 99 versus 23 losses, giving us hope that we shall be able to announce the 100th winning trade this week. Considering the last year and a half has been one of the more treacherous stretches in the market, we feel justifiably satisfied with our steady performance. Competitive Value Fund also had a good week. Although we closed NMDC at a loss, but the fund was bolstered by HDFC and TCS's move. We also entered IndusInd Bank later in the week for a tactical play. Our annualized return is running at over 9%, and the outperformance to Nifty stands at 7% on an annualized basis. For this week, we propose to be watchful in view of the expected correction before increasing our commitment.